I would urge each and every one of you to get maximum out of his experience on treasury bill, treasury bonds, and about the dealing practices, and more importantly, he has the qualification from ACI OC.
Right,
Yes, the qualification. So you will be benefited with this enormous amount of experience and qualifications. I will also be side by side with him. So let's share his knowledge and add whatever that I can do in a small way. At the same time, I have suggested to Mr. Karunaratne that we give you an assignment on treasury bills, treasury bonds, and in that market. And I have given him a draft. So most probably tomorrow we can share the information with you on the assignment. There again, like in the first assignment in the semester 1, we will give you about 3 weeks, 3 to 4 weeks to complete the assignment. And similar assessment process where assignment will carry 50% of the marks, and the end semester MCQ test will also carry another next 50% of the marks. So as we planned earlier, we could not have the first semester examination on the 2nd of May. We will be having it in about 2 to 3 weeks time. We'll let you know the date, and then as soon as the Institute of Bankers is cleared for student participation. So with that, I would invite Mr. Mangala Karunaratne to continue this presentation. And then his presentation has been hosted on the classroom by Mr. Menaka Vijayadasa. So you can download it and then read through it. At the same time, can I suggest to benefit Mr. Mangala Karunaratne, and then also those who have not met Mr. Mangala Karunaratne, and a round of introduction, like the way that we did for the first 2-3 weeks. Can you please switch on the mic and introduce yourself with the company name that you represent? All right, Mangala, that's okay, na? Your mic is muted. Your mic is.
Yeah, I on the mic. Yeah.
That's okay. So I asked them to introduce themselves by switching on the camera.
Yeah, that's good. Yeah. If you can do it, then I would be able to get to know about you.
Yes.
Yeah.
Right. Can we start with Kasapate Nakon? Yes. Hello.
Yeah.
Yes.
Good evening, sir.
Good evening.
I'm Asrif, working from Cricket Chapman and Company.
Cricket Chapman, right?
Yes, sir.
So, who are the others who are participating from your company?
Asantika Mohammed and Madhushika.
They are now?
They are there now.
So can you ask them to show their face on the camera, please? Okay. So that Mr. Karunaratne can know them, who they are.
Okay, sir.
Hello. Good evening, sir.
Good evening. Why don't you switch on the camera, please, Madhushika? Your camera is not working?
No, it's working, but I'm at home.
That's okay. Just to show your camera, just show your face.
Okay.
All right. Then Asantika, please. Asantika Mohammed. He's with you, no? She's with you, no?
So they both of them working from home.
Okay. All right. Then Cami Gabriel.
Good evening, sir.
Good evening. How are you today?
I'm fine.
Okay. Can you introduce yourself to Mr. Karunarathan, please?
I'm Clinton Cami. I'm from Bradley, McLean Roy.
Okay.
Right.
Only you or somebody else participating in your company?
Yeah, one person. It's Mahil.
Mahil Kavinda. Right.
Okay, Mahil.
Yeah.
Hi, sir. Good evening, sir.
Hi.
Good
Hi,
evening.
Mahil.
So I'm Mahil Kavind from Barclays.
Good. Super.
Thank you, sir.
Thank you.
Thank you.
Thank you.
Iran Fernando, please. Iran.
Good evening, sir.
Good evening. How are you?
I'm Kaushik Varan, sir. I'm from Vishwin. I'm fine, sir.
Good. Who else is participating from your company?
There are three more, sir. Trevor, Lakshan, and Saditra.
Right. Thanks, Iran.
Welcome, sir.
Then Sandarwan.
Good evening, sir.
Good evening, Sandarwan.
I am Tisar Sandurwan from SMB Money Brokers.
Yes. So you are at office or home?
Yes, sir. Office, at office.
Right.
There are two participants. Sir.
All right. Two of them.
Yes.
Who is the other one?
Carving.
Hello, good evening, sir. I'm Kavini from SMB Money Group.
Yes.
Oh,
Hi,
good.
Kavini. Yeah, thank you.
Okay, sir.
That's all. Lakshan came, no? Lakshan.
Lakshan Aluhare.
Hi, good evening, sir.
Switch on the camera, please. Good.
All right.
Good evening, sir.
Good
Hi,
evening. What's the company, Lakshan?
Vishwin, sir. Vishwin Money Brokers.
Vishnu. Right.
Okay. Madhushika. Mahil introduced, right?
Then how about
Praveen Steelman.
Good evening, sir. I'm Dave Praveen from George Stewart Investments.
George Stewart's. Okay.
Yeah.
There's somebody else also from your company, right?
Yeah, there are three others. Two of them are actually in medical leave. One guy is online, sir.
Yeah.
Right.
Can you ask the friend to come online?
Sure.
Good evening, sir. I'm Mr. Hinduranga from George Stewart Investments.
Isro. Good. Then Trevor Gomez.
Good evening, sir.
Good evening.
I'm Trevor from Vishwin, sir.
Trevor from Vishwin.
Yes, sir.
Good. Did Sadharwan Amardas introduce yourself?
Yeah, he came, no?
Yes, sir.
Yeah.
Right. Okay. Right, Mangala. Then you can proceed.
I'll start. First of all, thanks for the introduction, Mr. Ratnayaka. And as he said, we have been working for the last few years. Now, for the money brokers, of course, we couldn't have a recent one. After some time only, I think we are having one for the money brokers. But initially, we started, Mr. Ratnayaka started, and I also joined, that is some time back, maybe 15 years back. No, Mr. Ratnayaka, maybe 14 years back. So, yeah, long time ago.
Long time ago, about 7-8 years back.
7-8 years, yeah. Yeah, I started actually lecturing about 15, 16 years back, and then with the IBSL for a long time, like with the money brokers as well as the AIB examination. Now it's I'm doing the diploma part, financial markets operations subject for the diploma in banking. That is part 2 of AIB. I'll remove the mask in a while when others leave this place. We have actually back office. It's an enclosed area where other staff are also there, and then you can see my face as well. It's good to know each other, because now long time back when we started, all the money brokers came. So then I got to know them, and even now when we meet at functions or any other occasion, they, we know who are in the trade, right? So my area is mainly financial calculations. I think I have to share this, Mr. Ratnayaka, this.
Yes. There is a on the bottom right hand corner present now.
That one we have to press.
Yeah, click on that.
Right. Then a window, right?
Then you get that screen.
Entire screen, sir.
Yeah, this one, entire screen, no?
Yes.
Sorry. Yeah. Entire screen, and
then sir, click on that window and share. Right, sir. Now you can open the presentations. Bottom.
From my presentation,
yes,
right?
Yes.
I have already clicked, I think, that, no?
Sorry, sir?
I have already clicked that, no?
It should be minimized. See whether it's there. Otherwise, you can reopen it. Now, entire screen is shared now.
Yeah. I'll reopen it.
Right, sir.
Now you can see it, no?
Yes. Now you can start, sir.
Right. Okay. Thank you. So my area is financial markets calculations. Now I will first give you a brief description on the basis of these calculations. Now we will straight away go to the presentation. Now we have different calculation methods in the hello, you all can hear me, right?
Okay.
Can hear, no? Right. Okay. So right. Okay. So we will start again. Financial markets calculations is my area, and I will go through different products and how these calculations are done in different products and for what purposes. And first of all, I would like to bring to your notice certain calculation methodologies, in the sense why we need these calculations and how we do, and what is the basis of them. So now we have to start with day count and annual basis apply to different currencies. We need to know these few areas before we go into calculations now in financial markets. But first of all, I would like to say, like, we have very simple calculations as well as a bit complex calculations. But the only thing, although I say a bit complex, when you get to know about the basis of the calculation, you will find them very easy to perform, in the sense you very easy to calculate. So only thing now in this my presentation, or rather my lecturing session, I would introduce you to certain manual calculations which we nowadays don't use, but we use them in our automated systems. So now actually, in fact, when we do say, if you want to value a treasury bond, right, or a treasury bill, or any other calculation, all these things are now embedded into our computer systems. Now mainly in the banks, we have integrated treasury management systems, as well as even primary dealers, they have maybe smaller banks or small primary dealers have smaller systems than banks do have. But only thing, mostly these calculations, what I want to say is, mostly these calculations are now performed by machines or other systems, not like old good old days that you don't have to do these manually. But when we automate all these systems, and when we get the results from the machines, you tend to forget the basis of the calculation. So it is very important for us to know the basis of the calculation. Now for an instance, I know about, like, all the money brokers, you are experts in bond pricing and bill pricing. Though you don't deal much in forex, these government security calculations are actually very familiar to you. But here, what I am trying to teach you is the basis of these calculations. Now, for an instance, now we don't do manual calculations. As I said earlier, you can use the computer system, or you can simply use your bond calculator. When I start with the treasury, we very often use this bond calculator. Although we had a system, we used to check the calculations from the bond calculator as well, to ascertain whether the amounts are correct. And also now when we bid for the auction, now those data, there's no place in the system to enter, but we simply use the bond calculator to see whether the prices we are bidding are correct. And so these are based on certain principles of financial world. So start with the very basic one. You need to know the day count and annual basis applied to different currencies. So what is day count? Like, if you take treasury bills, we apply 364 days. I'm going through the basic things as well, because then it will be easier for you to grab my presentation, grab the flow of the presentation rather. So and if we take the treasury bonds, it's 365 basis, 365 basis, and across the currencies also you get differences. Now if you take treasury bill or a treasury bond in LKR, it's 364 and 365, but a treasury bond in US dollar, now we have actually US dollar bonds, that is international sovereign bonds, as well as Sri Lanka development bonds. Those are the day count basis is 360. And again, if you take a sterling bond, that is 365. So these day count and annual basis are really applied when we do the calculations, the interest calculations, the price calculations like that, and or accrued interest calculations. The day count is very important and very widely used. Another principle is the present value of money. So we use present value of money. Sometimes we call net present value also when there are many cash flows. And so that also I will be covering. So what I am covering in this session are NPV, net present value of money, and how to how do we apply that in financial markets. Then price calculation of treasury bills, price calculation of treasury bonds I will be covering, and interest calculation of repo and reverse repo. Interest calculation of repo and reverse repo, and also interest calculation of SLDB and interest calculation of ISB. SLDB is Sri Lanka Development Bonds. You know, they are denoted in US dollars, as well as ISBs, that is in international sovereign bonds. I will go through them later on in this lecture session of mine. Now after going through the mainly the government, now mainly in here we try to cover government securities, right? So now nature of calculations. Now, as I said, there are different types of calculations. Now, some calculations are based on simple interest. You know what is simple interest? You multiply it by an interest rate and get the interest amount component for a particular period, right? And yeah, now I want to tell you, like when I when I speak, I can't see you, and I don't see your facial expressions as well. So what I want you to do is, if you have any question, right, you can on your mic and ask. You tell me you stop you raise your hand, you stop the presentation, and you can ask any questions during the lecture also, because then it will be easier for me to go back if you don't understand anything, or if you want more clarifications. It's easier for me to go back and do it, redo it, and then explain it again. So coming back to the slide. So some are based on simple interest, actually. Some are based on compound interest. Now, if you say, sometimes we actually have these banking products which are on compound interest. So one is the savings account. The savings account is we give an annual rate of interest, but we pay interest monthly. So you get actually we calculate it on the daily balance and credit the interest monthly, and so the next month you get interest on that interest we credited to the account also. So that is called compound. So you get interest on interest. These are simple theories, but I just I'm just going through for your to refresh your minds. So, and some calculations are based on time value of money. As I earlier said, this is related to net present value or present value of money. So time value of money, some calculations are based on time value of money, and some are based on market norms and conventions. There can be calculations where you have the financial calculation plus certain norms or conventions of the market. So, and some like when I say market norms and conventions, you sometimes use maybe like you should know how many decimal places you take in a calculation, how many decimal places you leave out. Like, say if you get say 7 decimal places, the market norm is if you take 3 decimal or 4 decimal places. So the entire calculation is based on this, right? Why it is very important is now we do transactions with counterparties, and middle of that you all are there. So then all 3 parties should agree with the amounts, no? Like someone can't say no, I have got the settlement value 50 rupees less than yours. So other person will say no, it's not 50, it's 25. So like that there cannot be any dispute with regard to the settlement amounts or accrued interest or whatever it is. So it is very important to follow market norms, and when there are conventions, you have to know about them. When we do the calculations, I will let you know few of them, like how we do these calculations based on structure of the product. Some products are based on the product structure, because now if you take a treasury bond, the calculation is based on the face value of the treasury bond, no, not the amount you have invested. The coupon payment will be paid on the face value, not the amount the holder had paid to to acquire that bond. It's on the face value, like that. So some product, it's not like that. Say if you invest in a debenture, it's on the, there's nothing called face value, it's on the cash value, it's on the invested amount that you get the interest, right? And some calculations are based on interest payment period as well, right? Interest payment period as well. So these are some of the things that you will find in these financial calculations. So it's very important to know about this, because then you won't go wrong in the calculation, right? Now we are actually I would like to cover the government securities market, and these are the areas I will be covering. I will be covering treasury bills, treasury bonds, Sri Lanka development bonds, Sri Lanka sovereign bonds, and repos and reverse repos. Only thing I won't be covering the theory part in detail. I hope that Mr. Ratnayaka would have done, or he will do in future, the product features. But I will be giving you in a snapshot the product features. Then it will be easier for us to figure out the calculations with the product features. So other than that, I won't be extensively going into the product features, right? And so we will just go through treasury bills. Right now, on your right hand side, the description in the blue color background is what I am referring on your left hand side, but the description on the left hand side will be guided by this right hand side one, or rather it's like the heading of the slide, right? So this part is the heading of the slide, header of the slide, right? So treasury bills, I here say, are discounted instruments. Why do I say so? Because they have a face value and you can buy it at a lower value than the face value. So you are, every time you trade it at a lower price than the face value. So treasury bills are discounted. So issued for a face value, issued at discounted price, calculated on a yield. So this price is calculated on a yield. Yield is what? Yield is what you get. What is your the return on this investment. So that is actually yield. is usually when you quote a yield, it's quoted for you get an annual yield, right? If they say 6%, it's annual 6%. So in the calculation, if you want to know the 6 months, if you are doing a calculation for 6 months, simply you can divide it by 2, something like that. But there are certain things that we need to know when it comes to different products. But so calculated on a yield, this discounted price is calculated on a yield. And now here in treasury bills, the day basis is 364-day basis, and they are issued for 91 days, 182 days, and 364 days. And this is a money market instrument. Why do we call it a money market instrument? Now these are basic stuff, but I just want to go through, right? Money market, why do we call them money market? These are below 1 year, that is 1 year or below, 91, 182, 364. So those type of products we call money market, right? One of some other product, if you ask me for money market example for a money market product, you can we can name commercial paper. Commercial paper is a money market. In theory, it's 270 days, but there are different commercial papers. Some are actually, there are commercial papers which are more than 1 year, but usually commercial paper is a money market product because it's meant for less than 1 year. It's a product developed for a shorter period of time, right? Any questions up to now? I don't think that you have any questions because these are very basic, and you know, you do every day these things, right? Right. Okay. We'll go to a treasury bill calculation, but these. I think I have opened different. Just give me a minute. We were talking about treasury bills, treasury bill calculation. Now, treasury bill calculation is a very simple calculation. So I will take only a few minutes to explain that to you. This is one slide only. Now, now I said it's the discounted. It's a discounted instrument. So if we say now this is the formula is this. So the cash value, now usually if we want to find the cash value of that or the price of it, price of a treasury bill, then you have to divide this face value by yield into the day count into day basis, right? So this is the formula that we use for that. So this is also rather based on the present value, but this is very simple because one cash flow. So I give here an example to elaborate that. Now this T bill with a face value of 100, right? Now we are talking about a treasury bill with a face value of 100 for 90 days. 90 days with a yield of 6.61%, right? So my question is calculate the cash value. So T bill with a face value of 100 for 90 days with a yield of 6.61%, calculate the cash value. So now we know the face value 100. So we put here, now when we use a 6.61, this is the annual yield, right? So annual yield, this means 6.61%. So this when you put here the yield, you have to divide it by 100. So it's 0.0661. 0.0661 into 90 days. So our period is 90 days. 90 days. And then now here we divide it by 364 days. Why 364 days? Because treasury bill calculation, the day basis is 364. So from the from here you get 1.01634. So 100 divided by 1.01634 is 98.38. So we need 98.39 rupees, right? Rupees 98 and 39 cents to buy this treasury bill of 100 for the maturing in 90 days at a yield of 6.61%. So this calculation is very easy and very simple because it's actually we are talking about just one cash flow which is at the end of the period, which is at end of 90 days. You get 100 rupees. So they are asking if I want to get 100 rupees after 90 days and I need a yield of 6.61%. So let me know how much I should invest today. So that is 98.39. Do you have any do you want any clarification on this calculation? If anyone would like to have a clarification, can ask now. So I'm not touching treasury bills hereafter because treasury bill calculation is very simple and I don't want to put a lot of time on that, or rather it will be we can later on do some exercises after we go through the other calculations as well. But this is how we do the treasury bill calculation, right? Anyone wants to ask anything?
Mangala, just to interrupt, if this is there any accrued interest part when you
no, here actually it's a straightforward. There's no accrued interest here in this calculation because you are buying because now in the case of treasury bills it's always the discounted amount. Say suppose if you want to sell this now, say if you have this, Mr. Ratnagar, this bill, then you want to sell, then mostly important thing is both parties should agree with the yield. So we will be discounting this at that yield. So that is it. So the yield will cover everything because accrued, there's no such accrued interest here because your return is 100 minus 98.39. So that is why it's simple, because there's no accrued interest, there's no coupon interest as such, only the yield and the face value is there and the period. So it's simple as that. So now when we go into bonds, you will see how we calculate accrued interest, but here it's not.
Yeah. Yes, thank you. The difference is that in bonds you get several cash flows.
Several cash flows, and
but here one straight cash flow. Therefore, that is the reason why there is no accrued interest here.
Yeah.
Okay. Thank you.
Actually, here the other difference is now in a bond. Now bonds we will discuss it, but then in a bond we call them fixed income securities because we have there's a coupon interest rate decided at the time of issuance. At the time of issuance, so that coupon interest is the interest amount that you will be getting. But apart from that, when it is traded at a yield. No, it is traded at a yield. It is not traded at the people will not look. They will look at the coupon, that is certainly yes, but they will look at what is the yield you get by investing in that instrument. So that is the difference. Now here in treasury bills you don't have a coupon interest. So that is why basically we call them discounted instruments. But now when we go through it, you will understand the bonds also can be traded at a discounted price, or it can be traded at a premium or a discount. But it has a fixed coupon attached to it, which is actually decided by the issuer at the time of issuance. So that will not change during the period of its tenor, but only thing the yield can change, because people will look at the market and then they will ask for a yield, right? Yield is something to do with the market interest rate actually. So it is linked to the market interest rate. So it's linked to the interest rate in the market of this kind of a security, something like that, because government security, now we are talking about treasury bills and bonds, now treasury bills here. So these are actually then what is the yield one would expect from an interest free instrument. So that is how they look at this, no? So now in this example 6.61 is the interest free actually, sorry, the risk free, not interest free, risk free interest rate, risk free. So so this yield is the one people will try to achieve. So now when I want to make an investment, I would say, okay, I need at least 6.5% of this 6.5 return on this investment. So something like that. So 6.61% is the yield that both parties will agree. Now when you do a trade, there will be a buyer and a seller. Buyer also should agree and seller also should agree at this yield. So this calculation cannot go wrong actually. That is why we that is where we use certain certain market norms to take number of decimal places. So if I say it's 9839, I would pay to buy this. The seller also will say, okay, it should be 9839. Or if he says, no, it should be 99, then there's a dispute, no? But not like any other instrument, any other thing. Now say for an example, if you want to buy a house, right? Although there's a valuation, the price can be negotiated, no? The price can be negotiated. So there's no actually 100% certain price for an asset like that. But these kind of assets, financial assets, or financial instruments, assets, in the sense these financial instrument assets, they have a 100% calculated value. So there's nothing to negotiate, but the negotiation will be here on the yield. So you negotiate the yield actually. You negotiate here and then you arrive at a price. So this price is acceptable to all parties to the deal. So basically the buyer and the seller should mainly agree on this. So that is the easiest part in dealing with these financial instruments. Now if you take especially these kind of instruments, now if you take a debenture now, or a share, you say a share, we will say a share price cannot be calculated with the formula, no? There are models to that, financial models to get share pricing. Otherwise it will be decided by, now there are certain basis you can use asset based calculations and all that, but not very certain like this. So all parties should agree. Someone would not say I am at a disadvantageous position by using this formula or something like that. So if you agree on the yield, there's nothing that you have to worry on the price, right? So we will go to the next slide where I would try to explain you the treasury bonds. So treasury bonds, as I say earlier, are fixed income securities. Fixed income securities. Why do we say fixed income securities? If you invest in a treasury bond, your income, right? I'm stressing the point, income is certain. That is, say if you invest in 100 million bond, and if the coupon interest is 10, then you get 10 million. 10 million if it annually. If it is a semi-annual one, you get 5 million equal coupons. So that is why it is called fixed income securities, and periodical coupon interest will be paid. Now we have here in Sri Lanka the semi-annual government security bonds. Now we have some corporate bonds, but they are sometimes not carrying all the features of a bond. So mostly sometimes we have other debts as well, like debentures are not really bonds, but sometimes people say call them bonds as well, but they are not really bonds. But we don't have such corporate bonds here, which are similar to treasury bonds, right? So our bond market is mainly on treasury bonds, that is government treasury bonds, I would say government treasury bonds. So periodical coupon interest payments are there. So in the government treasury bond, it's semi-annual coupon, no, semi-annual. Now when you say semi-annual, it's twice a year, but the periods can be different with regard to number of days, right? Because we have different number of days for different months, but the coupon payment will be equal. Coupon payment will be equal and calculated on yield to maturity. This price, actually I'm talking about, the price is calculated on yield to maturity. I will explain it in a later slide, what is yield to maturity. And now here you find the difference. It's 365-day basis. Now I am talking about treasury bonds LKR, right? So 365-day basis, and usually these are 2 to 30 years, we say. Now we don't find 1 year bonds like sometime long time back, of course there were, but now you don't find 1 year bonds. 2 to 30 years, it can go beyond 30 years as well, but as a just to have an indication, the period we say 2 to 30 years. And since these are more than 1 year maturity instruments, these are called capital market instruments. Capital market instrument. This is a briefing on that. Briefing on treasury bonds. Some features which will be useful for us for our calculations, right? So now I will be doing, now from hereafter I will be doing price calculation of treasury bonds, and the assumption is actually treasury bond, the government treasury bond are semi-annual coupon payments, have semi-annual coupon payments. So we will say based on present value of money, this calculation. Now this is our task, like we have these bonds. As I say, the calculation is embedded in our systems, as well as you can use the bond calculator for this purpose. The main purpose of this study is to match that with the manual calculation, as well as to learn the basis of this calculation. And now say, suppose if we want to calculate it manually, you can do it. You should be able to do it after this this exercise, right? Or after these lecture sessions. So based on the present value of money, so this calculation is based on the present value of money. So all future receivables will be taken for calculation. So in a bond, all future receivables will be taken for calculation, and this will be based on required YTM. Why I say required YTM is, the required YTM is what is required by the buyer and the seller. Mainly the purchaser or the buyer will say, I need at least this yield from this bond, right? So it's based on required YTM and number of time periods till maturity. Now we have treasury bonds maybe going into 30 years, right? So So we have then say a treasury bond starts today and maturing in 30 years. How many cash flows you will have? You will have 60 cash flows, no? Because for a year you have 2, right? So likewise you have 60 cash flows, right? And then so this is the basis of our calculation, and I will explain you how we do it, right? How we do it in the sense how we treat each and every factor, right? So first of all, I will explain you the present value of money, right? What is present value of money? You know that an amount of money today is worth more than the same amount in the future, right? That means, say, suppose if you have 100 rupees today, it is more worth than 100 rupees you get tomorrow, right? Because today, one thing is you can invest that 100 rupees and you can get interest, right? That is one thing. So that is the financial explanation for that. In other words, sometimes you can say, okay, people would like to have liquid assets with them or more liquidity with them. So amount of money today is worth more than the same amount in the future, means that the present value of future money, say present value of future money is less than the future amount, no? Say suppose 100 rupees in 1 year, right? If you take the present value of that today, that is less than 100, because the present value, now we in the present value of money theory, we consider that opportunity of investment, opportunity of return which you are getting from investing the money today you are having, right? So in simple words only, I have given here an amount of money today is worth more than the same amount in the future. I think this you can understand well. So now we have a calculation here. Now this is called the present value formula. Now it's not complex actually, but then you need to understand this formula very well. Now we say here PV. PV is the present value, right? PV is the present value, and FV is the future value. So now say if you have a future cash flow, as I said 100, if you want to know the present value of it, if we use this formula, you can get the present value. So now at the rate of return, that is the rate of return, just give me a minute. I can remove the mask a bit. Now you can see my face, I hope, right? It's otherwise unfair. No, you all showed your face to me, and and now everyone has left, so I can I'm a bit free to remove the mask. So now going back to this, going back to the formula. Now what is rate of return? What is rate of return? Now this is the rate of return you will invest your money if you have money today, or or this is an expected rate of return. It can be an expected rate of return as well, right? Or it's an available rate of return. It's an available rate of return or an expected rate of return. And what is N? N is number of periods that you have to bring this money from future to present, right? I would say, say if you have to bring this money from one period, that is, say if it is a semi-annual government security, government bond or a treasury bond, then maybe we will say this bond is mature. Say today is a coupon date, exactly the coupon date today, and its next coupon is due in 6 months, right? So this 6 months period we consider as one period. So the next coupon, if you want to get the present value of that, you will be discounting it, or you will be using n as 1, right? You will be using n as 1. So if it is like, say, as I say, if it is a treasury bond with 30 years to mature, right? If you have 60 coupon payments with the last coupon payment plus the maturity, 60 coupon payments, so you will have 60 cash flows, right? So n will be 1 to 60. So first cash flow you will be using n 1 as n, so or the value of n as 1. Second one, value of n is 2. Third one, it's 3. Like that, it will be going up to 60. So I am actually trying now this formula we can use for multiple cash flows or a single cash flow. But in the multiple cash flow, the formula is a bit complex. So in our calculation, what I will do is I will use this formula separately for each and every cash flow, right? Each and every cash flow, then you can understand this. This is a very, if you are into finance, like finance studies, you know, this is a very important concept, this present value formula. And this formula, if you take maybe 60 to 75 of the financial calculations, mostly they use this formula for various things, right? So learning this thoroughly is very important. Learning this thoroughly is very important, because I know actually when I started when I started my lecturing career, I started mostly, I can remember a long time ago, started with this formula, how to then I found it in so many places. It is it is applied in various areas. So it's very important for you to understand all the factors of this formula: present value, future value. This one is actually a number, and R is rate of return, sorry, and N is number of periods that you have to bring your cash flow from future to present, right? You can remember like that: to bring your cash flow from future to present, how many number of period that you have to pass, right? So when we do the bond calculation, you will understand, and we will go to the next slide. So now I will explain one by one, right? Now in the bond calculation, as you say, we need the future value. So if we are using this, we need the future value. What is future value with regard to a bond? With regard to a bond, the future value is the future receivables of a bond. So you can see the right hand side in blue background. Future receivable of a bond is the future value. Actually, future value means you get in a bond, you get so many future receivables. What are the main future receivables? Future coupons. The main ones are, not main ones, actually two types. You have future coupons as well, and then you have the maturity amount. So maturity amount, when you say the maturity amount, what is the maturity amount? Maturity amount is the face value of the bond. No, you get the face value of the bond at the maturity. So this is one cash flow actually, maturity amount. And don't forget that we get the last coupon with this maturity amount. You get this last coupon with this maturity amount. So future coupons plus the maturity amount. So if it is, if a bond is maturing exactly 4 years from today, so that will have 8 coupon payments. That will have 8 coupon payments, and the last coupon payment is the 8th one, which you will get with the maturity amount. With the maturity amount. So that is how we define, or rather we take these future receivables of a bond. So future receivables are future coupons plus future amount, the maturity amount, that is the face value, right? So and now we have this, we are going again back to this formula, the rate of return. So what is the rate of return you are expecting from a bond? What is the rate of return you are expecting from a bond? You are expecting a yield, right? Now we call this yield to maturity. Now because there are other definitions for the yield. So when you say simple yield, right, it's maybe from today to from today to another 1 year, 1 year ahead, what is the return you get? So that you call yield. So now here, now in that case, we don't consider the maturity as a fact, but we just want to know what is the 1 year yield. So that is, so you invest today and the next 1 year, what would you give? So I will actually in a later lesson, I'll be explaining you yield to maturity, yield, and the relationship between the yield to maturity, and the coupon, right? But for the time being, now now when you do a trade, when you do a bond trade, they talk about the yield, no? Now they talk about the price, but price comes later. You trade for the yield, no? You don't trade for the price. Now we are so familiar, now they quote the price, but then before that, what comes into their mind is the yield. What comes into their mind is the yield, not the price, right? So so this particular yield, which is relevant to the bonds, we called it yield to maturity. We called it yield to maturity because there's a reason for it. So what is it actually? The total return anticipated on a bond if the bond is held until it matures. So you have to get this yield. If you want to get this yield, you need to keep the bond until it matures. If you sell it halfway through, then you get a return, but not this yield, right? So that is why they say it's yield to maturity. So it has to, you have to keep it till maturity. You have to keep it till maturity. And sometimes you can say it's the internal rate of return as well of an investment in a bond if the investor holds the bond until maturity. So that is another definition I have given, but this first one is the best explanation for that, because if someone wants to know about yield to maturity, you say the yield to maturity is the return anticipated on a bond if the bond is held until it matures. So we have now learned two areas of this: the future value, how to get the future value of a bond, and what is the rate of return. Now when we are trying to use this formula for the bond price calculation, actually in fact this is the formula everywhere in the world they use for the bond calculation. So we try to ascertain the present value of future cash flows. That is the basis of this. So because money is actually money value can be ascertained at any time, any slot in time, like in the sense say you can say now if you have 100,000, there can be inflation and other factors coming into this picture, but we don't consider it. Now we consider them as a whole, like at this situation what is the return you want, something like that. So that is how you calculate, you do these investments, right? So now we are trying to the basis here is, I'm again explaining, the present value of all future cash flows are the price of this bond, right? So now future coupons, we went through future receivables of a bond, future coupons, and maturity amount, right? Then yield to maturity, the total return anticipated on a bond if the bond is held until it matures, right? Then the next thing, time till maturity. Now we need to know how many time periods, or what is the distance the money has to come from future, right? What is the distance the money has to travel from future to today, then, or from today to future. Then only we can know if we have one value. If we know today's value, or if we know future value, then we can, if we know future value, then we can know today's value, that is the present value. So if we know present value, we can know the future value. But the yield to maturity, or the rate, or the yield only is not enough, right? You have to know the distance it has to come. So distance it has to come, actually we know it's time, right? Distance means the time, right? So here we try to calculate how many time periods, though the time till maturity is divided to coupon payment periods. Why do we do that? Why do we make them, why do we divide to coupon payment periods? We divide them into coupon payment periods because a coupon payment period is a period where from one cash flow to the other. So today you get one cash flow, the next coupon is the next cash flow. Then after that, the one after the other, the coupons are coming at a pre-decided interval, right? Pre-decided interval, in the sense, now in this government security is, or the treasury bond, you get every 6 months coupon. No, every 6 months coupon. There can be other bonds in the market, not here actually in Sri Lanka, but when we talk about bonds, we talk about 1 month interest payment bonds, 1 month coupon payment bonds, 3 months coupon payment bonds, and 6 months ones are the very popular one, and 12 months coupon payment bonds. But 1, 3, and 12 like that we don't have here. So we are actually, I'm considering here the government security treasury bond for semi-annual coupon periods, right? So say if it is 1 year away from today, then that 1 year away cash flow has to travel how many coupon slots, or how many coupon periods? Can someone tell me, just to just to make sure myself that you understood it? How many maturity, coupon payment exactly 2 years from, exactly 1 year from today, right? A coupon payment exactly 1 year from today of a semi-annual coupon bond. I am asking that coupon payment after 1 year, how many time periods that it should travel from future to present? Can anyone on the mic can tell me? Hello? Speak, please.
Please speak up. Please speak up.
I just want to, know that it's not like, explaining on the board, no. So I just want to know whether you understood or whether whether my explanation is enough or it's too much, right? Tell me, someone. Is the question clear? Sorry? Can't hear properly. Can't hear properly. My question is, semi-annual coupon bond, coupon payment exactly from 1 year from today. Exactly 1 year from today. It's a semi-annual coupon bond. How many time periods that it has to travel from future to present, right? How many time periods? That is, I'm asking N. Two, yes. Yeah, 2 time periods. Good, yeah. So if others have also thought of 2, then you are correct. Otherwise, you can ask me. Now, because this is actually a very important thing. I'm not talking about a bond traded halfway through. Now, we don't trade bonds exactly on the coupon day, no? We don't do that. Like maybe say first of, we will say a bond issued on 1st of April, right? We'll have a 1st of October coupon as well as 1st of April coupon. So say a bond like that, if we trade today, it's not exactly in 6 months that you will get the coupon. You will get in a broken period, right? I have not come to that level yet. I ask a semi-annual coupon bond, a semi-annual coupon bond bonds. A semi-annual coupon bond is there. A cash flow you receive from that bond after 1 year, right? How many time periods that it has from today, from present to future? So actually it's 2, because from today one period is in 6 months, the other one is in 1 year. So this has to travel. If we want to calculate the present value of that, it has to travel 2 periods. So my point here is the n is equal to 2. N is equal to 2 in this calculation. N is equal to 2. I want everyone actually to master this calculation. This is very useful, right? This is very useful, and actually, in fact, all the people who came for last sessions, they learned thoroughly this, and they really appreciated, because this is the basis of our our bonds, right? Bond calculation entirely, it's here. You don't have to bother. I will show you and I will match. Now in the books the formula is there, but then you don't see exactly how to arrive at the bond calculator figure. They will give you a figure, but which doesn't tally with this. But I will show you with the market norms how you exactly tally this with the bond calculator. You can, if you have bond calculators with you, you can calculate with me. We used to do it on the board, but now since we can't meet up, then I tried and developed these slides very carefully to put every detail here for you to understand this very correctly, and without any doubts. So this n then is, now in that actually the future value is that cash flow after 1 year. 1 plus r is the rate of return, annual rate of return. Now everywhere when you ask for a rate, they will quote the rate or the yield on what basis? Annual basis. No, annual. They don't now say, if you go to a bank can ask for 6 months treasury, we will say 6 months fixed deposit rate. So they will say 6 months FD rate is 5%, sir. So when we say 5%, so it's the annual rate. So 6 months, if you talk simply, then it's half of it only you will get. It's not that you get 5% for 6 months, it's 5% for 1 year. So you will get 2.5 for 6 months. If you talk very simply, if you want to say, it's 2.5%, but there can be changes due to number of days, but it's 2.5. So likewise, this rate you have to keep in mind. This rate is an annual rate, right? Annual rate we are using. So yield by time. So one coupon payment period is taken as one time period, because we take this as one time period because it's very easy to calculate, because you know the cash flow exactly for that period. You can you know the yield to maturity, or you know the interest rate, or you know the yield for that period. So if the yield to maturity is 10%, then what is the R for this period? Say in a bond, right? In a bond which has a yield or yield to maturity of 10%, right? What is the rate you use for this one coupon payment period? It's half of it. Half of it. So that is half of it, 5%. So like that, it's very easy. If you take one coupon payment period as one time period in this calculation, right? If it is not very clear, this please ask me, right? Please ask me, then I can explain it again. Now this is the bond. So I will this is the example I am actually trying to elaborate in the class. Bond price calculation of a semi-annual coupon bond. Bond price calculation of a semi-annual coupon bond, right? So
Mangal, may I interrupt, please?
Yeah, sure.
6:30 time is up.
Yeah, give me just give me 5 minutes for the last time. I will finish it off, right? Just to explain this. I will explain this. This is about this, not the figures actually. This is a real time when I long time back example, but this is a real example I took from one of our deals, right? One of our deals with a counterparty. So at that time, it was 50 million deal. The bond was issued in 15/4/2006, and the maturity was 15/4/2012. That was a 6-year bond, right? That time the coupon interest rate of this bond was actually 6.85. That time the rates were like this. So the coupon interest rate was 6.85%, and the settlement date was 9/10/2010. That actually, now we have to see, we have to go back to 9/10/2010 and do this calculation. And the yield to maturity expected and used in this calculation is 8.70. So we have come to a very interesting part in this lecture. Actually, you will find it interesting because if you haven't done this NPV calculation or previously, or if you are doing it for the first time, or if you really would like to know the bond price calculation, this is the start of it actually. So I think I brought you brought you through a session to explain the background of these government security calculations. Basically the treasury bill, I didn't emphasize much on that because it is a simple calculation, but we can go back to that if you don't understand it. And if you have examples with you, you can put to that formula and see whether you get the exact discounted amount as in the as in actual trade, and then I actually explain you the net present value formula and how we go and fit the treasury bond details or treasury bond the data into that formula. So we will tomorrow we have a class, no, Mr. Ratnayaka, 5 o'clock. Hello.
Yes, we do have.
Yeah, we
It is,
have
Tuesdays, Wednesdays, and Thursdays.
Thursdays. No, so we will be taking. I will be taking a lot of time on explaining this, because we need to make sure that everyone understand this formula and this calculation. So
that's very good.
I will not going through very fast, but this I am really sorry for sharing a different the presentation. It was a mistake, and this presentation I will send it to them, to IBSL, or rather to Menaka, to share with you. Then you can go through it before you come to the class tomorrow, and hope to have a very interesting session tomorrow, and hope you like my lecture today. Right, okay, thank you so much. Then we will call it a day.
Yes. Thank you, Mangala. And then tomorrow, the normal classes are held on Tuesdays, Wednesdays, and Thursdays.
Right.
5 to 6:30.
Right.
So now I think you can take almost 3 weeks.
Yeah, 3 weeks I will take all these classes. So I will start at 5, because we close at 5 now. So
Yes.
5 to 6:30. Please bear with me that half an hour, which I want to explain. Right?
Yeah, that's good.
Most of them I think must be at some of them are at home, no? So no issue.
Yeah, some of them are at home, a few, but most of them are in their offices.
As well, no? Right. Okay, that's good. Yeah.
Yes.
If you can bring a small calculator, not really necessary a bond calculator, but if you can bring a calculator, you can, when I do the calculations, you can do it with me and see whether you get used to the calculations. So that is very important. If you can bring have a calculator along with you for the class.
Okay.
Okay, thank you so much.
Thank you, Mangala. Then probably we will be able to share with them the assignment also tomorrow, right?
Yeah, I will finalize it today, and then we will share it.
Right. All right.
With them.